Most Canadians know there's no gift tax in this country, and that's true. But that accurate piece of information is exactly what gets families into trouble. Because while there's no gift tax on cash, the moment you give away property, shares, investments, a rental property, a cottage, the CRA has a completely different rule that kicks in. And most people don't find out about it until after they've already made the decision. Today, I'm going to show you exactly what that rule is, how it plays out, and what you can do instead. Hi, I'm Stefano Francesca, Certified Financial Planner Professional and Senior Wealth Advisor at Next Step Wealth Management with IPC Securities Corporation. In this video, we're talking about one of the most misunderstood tax rules in Canadian retirement planning, the deemed disposition rule, and why it catches so many generous Canadian parents completely off guard. And here's what makes this so important. This isn't just a fringe situation. This is something I see regularly with well-intentioned, financially responsible Canadians who simply don't know the rule exists. If you find this helpful, don't forget to like and subscribe. It really helps more Canadians see this. Before I get into the examples, let me explain the rule itself in plain language. Canada genuinely has no gift tax. If you give your adult child $50,000 in cash today, nothing happens from a tax perspective. They don't report it as income. You don't report it as a transfer. The CRA isn't interested. Why? Well, because you're transferring tax-paid capital. But the moment that gift is appreciated property rather than cash, so shares, an investment account, a rental property, a cottage, even cryptocurrency, everything changes. Under the Income Tax Act, when you transfer appreciated property, like in this situation, the CRA treats it as though you sold it at full fair market value on the day you transferred it, whether you received a single dollar or not. That's called a deemed disposition. And what it means in plain language is this: the gain between what you originally paid and what the property was worth the day you gave it away is a capital gain reportable for that year. In Canada, the capital gains inclusion rate for individuals is currently 50%, meaning half of that gain gets added to your taxable income and taxed at your marginal rate. You pay tax in the year of the gift, even though no money came back to you. Let me show you exactly what that looks like, because this is where most people go quiet. Say you've spent 20 years slowly building a position in Canadian bank shares. You paid $20,000 total for them over time. Today, they're worth $80,000. Your child is struggling and you want to help out. You hear somewhere that you can transfer money to kids tax-free. So you decide to transfer those shares to help them out. Here's what the CRA sees: a disposition at $80,000. Not just a gift, a sale. It's as if you personally liquidated those shares, then gave your adult child the cash. Same tax consequence. Capital gain, $60,000. At 50% inclusion, $30,000 gets added to your income and taxed at your marginal rate. For many Alberta retirees already drawing CPP, OAS, and RIF income, that marginal rate could easily be 30.5% or higher, meaning a tax bill of $9,000 or more. On money you never used. You gave your child $80,000 worth of shares. You also handed yourself a $9,000 tax bill on an asset that just left your hands. Now you'll have to find a way to pay for that tax bill. Your child, for their part, receives those shares at fair market value on the date of the transfer. $80,000 becomes their new cost base. If the shares rise and they sell later, they pay tax on the gains from that point forward. That could be advantageous to them if they are in a lower tax bracket. But you can't escape the gain which was made while those shares were in your hands. The trap lands entirely on you, not them. Remember, you can transfer cash without any worries. Transferring appreciated assets will trigger a deemed disposition. Special note here: because we're saturated with American information may be the reason many Canadians misunderstand transfers of assets being tax-free. Always check that you're reading up on Canadian tax rules, not American tax rules. Now let's talk about property. This is where I've seen families lose the most amount of money. Not from bad intentions, just from not knowing. Parents who own a cottage or investment property often think about transferring title to their children to simplify their estate or to start giving while they're still alive to see the impact. Here's the reality. A property purchased decades ago probably carries an enormous embedded capital gain. And the moment you transfer it, even as a gift, even with the best intentions, that entire gain triggers in the year of the transfer. Think about what that looks like in practice. A property bought 30 years ago for $100,000 is now worth $600,000. Capital gain, $500,000. At 50% inclusion, $250,000 gets added to your income in a single year. At combined federal and Alberta provincial marginal rates on a gain that size, the resulting tax can be substantial. In many cases, reaching into the six figures, depending on your other income that year. And here's what makes this really frustrating. Whatever estate simplification benefit families were hoping to achieve, in most cases, the tax complications and cost of doing it now just brings the headaches forward. Here's where it gets worse. A lot of people think they've found a workaround, a loophole. Sell it to your child for $1 or some crazy low price. That doesn't work. Section 69 of the Income Tax Act was written specifically to close that door. When you transfer appreciated property on a non-arm's length basis, like to your adult children, for less than fair market value, $1 or any amount below market value, the CRA still calculates your capital gain as if you received full fair market value. You pay tax on the full appreciation regardless of what was actually paid. And here's the second hit. When they eventually sell at market value, their capital gain is calculated on the difference they actually paid, say that $1 or that ridiculously low price, thus creating that double taxation. Selling below market value may create tax consequences for both the transferor and the recipient. It duplicates the damage, once for you and once for your child. I want to stop here because there's a second hit that almost nobody understands, and it catches retirees who are already managing their income carefully. When you trigger a capital gain by gifting appreciated property, that gain gets added to your net income, line 23600 on your return. And that's the number the CRA uses to calculate the OAS clawback. For 2026, the OAS clawback threshold is $95,323. Above that, the CRA claws back 15 cents of OAS for every dollar over that line. So imagine your retirement income normally sits around $70,000. You transfer shares with a $60,000 capital gain. After the $50,000 inclusion, your net income jumps to $100,000. Now you are above that clawback threshold and your OAS starts getting clawed back. And then there's the timing. The clawback is based on your prior year's return. So the gift happens this year, the tax bill arrives in the spring, and then your OAS payments quietly shrink starting the following July, creating a change in cash flow. 3 separate financial hits from one decision. And the third one shows up months after you thought it was all settled. If you're considering transferring assets to your children or grandchildren and want to understand the full tax picture before you do anything, click the link in the description to book a consultation. This is one of our priority discussions in our next step wealth management strategy. We'll walk through your specific situation and make sure you understand the full cost before you act, not after. So what are a few ideas you can look at? Well, start with cash. If you want to help your children financially and you have liquid savings, giving cash avoids the deemed disposition entirely. The CRA just isn't interested in cash gifts between family members. Cash is always the cleanest way to help. As well, using assets from your TFSA could also help you avoid any nasty tax consequences, especially if you're already touching up against those higher tax brackets. Secondly, review your goals and see if this type of help is something you can afford, not just from a tax perspective or tax bill perspective, but determine if those assets are material to your retirement success. You need to make sure you're okay first. If you're going to be okay, then build the transfer of assets into your plan so that it can be part of your tax strategy. In many cases, we help clients bracket size their taxable income so that they can accomplish both goals tax efficiently. Thirdly, in the case of a cottage or rental property, understand first if your kids really want it, including all the upkeep, maintenance, time, energy, effort, and actual costs it takes to have a property. Be honest with each other. Have all stakeholders share their concerns in order to avoid doing something that nobody really wants. Number 4, understand your tax brackets currently and into the future. Sometimes it's best to transfer the future tax liability of an asset to your children before the asset creates a significant tax problem for you in the future. Or you might determine that transferring that asset today is going to create a current tax problem even bigger than the one in the future that you're trying to solve. Here's a good example. In Alberta, with income between $117,000 or so up to $154,000, you are at a 36% combined federal and provincial tax rate. Add in the OAS recovery tax, and you're paying 51% tax. That's more than the highest tax bracket of 48% in Alberta when you exceed $370,000. Someone with this income profile will really have to evaluate the benefit of prepaying tax. Finally, if your goal is building something for grandchildren, look at the RESP. Attribution rules that apply to assets held for minors generally don't apply inside a registered education savings plan. Income accumulates sheltered, and when the money comes out for education, it's taxed in the student's hands, usually at very low rates or at no tax at all. And let's not forget all the grants that are accumulated within that RESP as well from the government. In summary, Canada genuinely has no gift tax, but no gift tax on cash and no gift tax on property are two completely different situations. And the gap between those two statements is where the tax bill comes from. Families who get caught by this aren't careless. They're generous. They want to help their children while they're still alive to see it. And nobody told them that the method they chose came with a tax bill they weren't prepared for. If you're a Canadian retiree or within 5 to 10 years of retirement, and you're thinking about transferring assets to your children or grandchildren, click the link in the description to book a consultation. We'll walk through exactly what you own, what the tax cost of transferring it would be, and whether there's a better strategy to accomplish what you're trying to do. Because here's the reality. Right now, you might be sitting on appreciated assets and thinking about how to help your family. The instinct is a good one, but the method matters enormously. And one conversation before you act could help you avoid costly mistakes. The goal isn't to stop you from being generous. The goal is to make sure your generosity doesn't cost you a tax bill that changes your own retirement. And if you want to dive deeper into retirement planning, make sure to download my complimentary retirement guide. The link is in the description. Let's take the next step.